So hi everyone, my name is Serena and I'm the Lead Market Analyst here in APAC. Today, I'm joined by Rui Jie, who is our Regional Product Specialist. And together, we'll be sharing on Asia's crude and refined products trade flows in 2021 as the region embarks on the road to recovery. Now, this will be a 20 minutes presentation followed by a 10 minutes Q&A. So along the way, as you have any questions, feel free to pop them in the Q&A box on your screen. And also, a recording will be made available to you after the session. We'd also like to invite you to do a quick 1-minute survey, if you could, to help us understand how your experience of this webinar has been today. So with that, let's start. So COVID-19 took the world by surprise and upended the oil market in 2020, leaving the world awash with crude and refined products. This year, as Asia's oil demand pulls ahead of the rest of the world, we are starting to see a rise in crude imports into the region. Higher refinery runs in China and India have contributed to stronger refined products exports, with most of the barrels kept within the region as arbitrage opportunities remain limited. Now, the startup of new refining capacities in China is competing for market share within the region and has placed immense pressure on older, less competitive refineries. Several refineries have caved under pressure, with potentially more rationalisations expected to come this year. So in today's session, we'll be exploring these shifting trade flows in Asia and their implications on freight using Vortex's real-time cargo and freight analytics data. So the first question to ask is Asia's crude runs back to pre-COVID levels? So Asia's refineries, particularly China and India, have been one of the front runners in raising crude runs compared to other regions. Here in this slide, we see the crude imports for China and India, as well as the rest of Asia, which can be kind of used as a proxy to refinery runs. So on the first chart on the left, we see China's crude imports, which began to rise in earnest from May last year as refiners went on a buying spree to slurp up cheap crudes in the market. And we see the strength in China's crude imports continuing into this year, with over 10 million barrels per day of crude arriving at the shores in January and February amidst robust crude runs. But crude imports have started to slow this month with the onset of refinery maintenance, and that is expected to last through May. And we expect refiners to step up their crude purchases again in April as they prepare to run up refinery runs after the maintenance. But the high crude inventories in China means that refiners do have the flexibility to delay crude purchases if prices remain unattractive. Also, as new refining capacities, such as the Zhejiang Petrochemicals, as well as the Limingang refinery starts up this year, it will prop up the country's crude imports, and therefore, we expect China's crude imports in 2021 to be higher as compared to last year. While as for India, the country saw a steady rise in its crude imports from the third quarter last year, very much driven by the lifting of travel restrictions and the festive season. But unfortunately, this year, a resurgence in COVID cases in several states, including Mumbai, Tamil Nadu, and Gujarat, has threatened to derail the country's oil demand recovery. And in fact, the rise in gasoline and diesel retail pump prices has also curtailed the earlier demand growth, weighing down on the refiners' crude runs. But we think that the Indian refiners could get a silver lining to increase exports into the region in the coming months amidst reduced exports from North Asia's refineries during the seasonal maintenance. And this could help to cushion the impact of weaker domestic demand on their crude runs. Well, as for the rest of Asia, crude imports and in turn refining runs have remained tepid because of a well-supplied regional market. And in fact, the run-up in Brent prices this year has further quashed, upsides on refining margins. And in fact, the older, less competitive refiners in the region are finding it increasingly challenging to compete, with the newer complex refineries. And the closure of Australia's EP Kwinana, the Philippines' Shell Tembangau, among others, have been evident of this trend, and more refineries could join the line this year. So as such, we expect crude imports by the rest of Asia to remain flat, at least through the second and third quarter of this year, with upside seen from a stronger regional demand recovery in the fourth quarter. Now, we see that, looking at a breakdown of Asia's crude imports by source, the Middle East Gulf producers have been the biggest winner so far in growing its crude market share in Asia, with arrivals into Asia rising by more than 5% this quarter as compared to the third quarter of 2020. Well, this comes as no surprise because the Gulf producers, medium and heavy sour crudes, continue to form the main crude staple for Asia's refiners. And the widening of Brent premiums to Dubai this year has kept the Middle Eastern grades competitive relative to Brent grades from, say, the West Africa as well as the Atlantic Basin. Well, as for the European grades, grades such as the medium sour, Johann Sverdrup, the lighter 40s, and the Azeri light grades, they have found favor with the Asian refiners, particularly China. And that is supported by the subdued demand in Europe, as well as the low dirty tanker freight rates. So VLCC utilization for Johann Sverdrup, for example, hit a record high of 15 vessels in February, and that translated into ton-mile demand hitting a record of 26 billion ton-miles. But loading activities in March have kind of slowed as the widening of the Brent-Dubai differentials to above $3 per barrel in recent weeks have led to the Atlantic Basin grades kind of losing their shine. And similarly, the West African grades have also taken a hit, hindering the arbitrage flows to Asia. Well, as for the US crude, we see a strong 1.3 million barrels per day arrival into Asia in the first 2 months of the year. And that was a result of purchases that were made last year. But loadings of US crude in February has slipped to 700,000 barrels per day, and that's partly attributed to the Texas storm that disrupted the crude production and loadings, but also the Asian refiners' reduced appetite for crude. March loadings to Asia are expected to be at the preliminary of 670,000 barrels per day. But throughout the course of the year, we believe that the arbitrage flows of US crude to Asia will continue to be supported as long as WTI Dubai spreads are attractive and freight rates continue to stay low. Well, while crude exports to Asia have been a key focus for the market this year, interesting trends have also emerged on regional clean product trade flows, and we'll be exploring the shifting trade flows from China, India, and South Asia in this next section. So we see that China's gasoline exports in January and February this year has remained relatively flat as compared to the fourth quarter of last year, with majority of the barrels really heading towards Singapore, Malaysia, as well as end-use markets like Indonesia and the Philippines. But what's interesting this month is that there's been a string of tankers provisionally booked to load gasoline from China to West Africa. And these gasoline outflows are expected to add further tightness to the region amidst the seasonal maintenance and support gasoline cracks. Well, as for India itself, gasoline exports have risen by more than 15% in the first 2 months of this year compared to the fourth quarter of last year. And more gasoline cargoes are seen heading to Indonesia and Singapore during this period, as compared to, correspondingly fewer to UAE as well as the US. Well, India's gasoline exports outlook very much depends on its domestic demand, which is currently under threat by a rise in infections. As for South Korea, what's really interesting is that we've seen refiners raising exports of alkylates, which is a gasoline blend component, to US West Coast PADD 5, with trade flows rising by over 20,000 barrels per day in January and February as compared to the last quarter. And this trade flow is likely to be sustained with the switching to summer-grade gasoline production in the US. Well, as for diesel, China sprung a record diesel exports in the first 2 months of this year, and that's a result of the double whammy of robust refining runs, as well as deflated diesel demand from the short-lived pandemic resurgence in North China at the start of the year that led to a strong buildup of diesel surplus in the country. And in February, refiners pushed out a record of 560,000 barrels per day of diesel exports into the region that headed mainly to Singapore, Philippines, as well as Australia. And with the shutdown of refineries in the Philippines and Australia, we've seen diesel imports into these two countries rising over the year. We're also seeing more diesel barrels from India heading to Togo this year, which makes an excellent storage location, bringing it closer to end-use markets in Europe as well as Africa. While as for Singapore, it is another storage location that has received more diesel cargoes from India, contributing to the rise in the country's middle distillates inventories in recent weeks. But the ongoing refinery maintenance this season in Asia will bring a rebalancing of supplies into the region, alleviating the surplus. So moving on to the next slide, we see that another trend around the middle distillates where new build VLCCs carrying middle distillates from the east to the west has continued this year and could further see a pickup as demand in Europe returns later in the year. So arrivals of diesel and jet fuel aboard these new build VLCCs has totaled 130,000 barrels per day during the first quarter of 2021 and has been the highest since the third quarter of 2019. And the rise in arrivals this quarter is partly a function of tankers recently departing from East of Suez, but also due to the discharge of cargoes previously held in floating storage, with many of these cargoes originating from India, UAE, as well as South Korea. And in the first quarter this year, European imports of middle distillates are on track to fall on the quarter to around 2.3 million barrels per day. And so that is still testament of the length that we are seeing in the region. But looking forward, the recent departure of VLCC Diodorus from East of Suez, given its latest declaration, suggests that Europe could once again emerge as the preferred destination for VLCC cargoes in the second quarter. And this is possible with easing lockdown measures and vaccination rollouts in Europe ahead of summer, which is supportive for diesel demand and imports into the continent. Between March and June this year, we're expecting at least 17 VLCCs to be delivered and therefore presenting more opportunities for this east to west diesel flows. So with that, I'm going to hand over the time to Rui Jie, who will share with you more about some of the Southeast Asian market trends that we're seeing this year.
Thank you, Serena. Closer to home, the outlook for the recovery in demand of transport fuels in Southeast Asia is a mixed one. In Myanmar and Vietnam, the effect of the pandemic on transportation has been relatively muted. We have in fact seen a recovery of their gasoline and diesel demand, and in turn, imports to pre-COVID levels last seen in 2019. However, demand in countries such as Indonesia and the Philippines remain decimated by the pandemic owing to reduced mobility and economic activities. Notably, Philippines transport fuel imports in the first quarter of 2021 are currently above pre-COVID levels, likely a direct result of the closure of Shell's Tabangao refinery last May, and the temporary closure of Petron's Lime Batan refinery at the end of January this year. Imports are expected to remain elevated until domestic production returns, which was recently reported to happen in the second half of this year. Meanwhile, in Australia, gasoline demand continues to be weighed down by reduced passenger car travels, with intermittent lockdowns imposed across various states. Diesel demand, on the other hand, has been propped up by the robust mining and industrial sectors. We expect to see a rise in gasoline and diesel imports into the country owing to refinery closure, the effects of which we'll be discussing in detail in the subsequent slide. So in this section, we'll be talking about some refinery closures and rationalisation, starting with Australia. With BP's 146,000 barrels per day Kwinana refinery shutting down permanently this month, we estimate at least a 20% rise in gasoline and diesel imports into Australia year on year. In fact, we have observed a doubling of transport fuel imports into the port of Kwinana in February against the December-January average, with barrels arriving from mostly Singapore, China, and the Middle East. These imports are projected to rise further when ExxonMobil's 90,000 barrels a day Altona refinery shuts, although no firm timeline has yet been announced. Supplies to replace Altona refinery's production are likely to be obtained from the parent company's two large refineries in Singapore, one in Jurong and the other in Pulau Air Cawan, with a combined capacity of 592,000 barrels a day. This flow will not be new, given that refined product exports from these Singaporean refineries to Altona has been a regular occurrence, with at least one MR cargo plying that route every month in the last 2 years. Consequently, demand for MR tankers will receive a boost of an additional 10 MR-sized tankers per month with both refineries shut. This will likely be music to the ears of tanker operators that have seen this size segment underperforming so far in 2021, with freight rates in the region having fallen by 21% in recent weeks against those back in early January. Simultaneously, more cargoes may be seen arriving on the larger LR tankers, taking advantage of the economies of scale that can be reaped for freight optimization purposes. So in stark contrast to the blight of refinery closures in Australia, new integrated refining petrochemical complexes have been popping up one after another up north in China. After the startup of Hengli and Rongsheng's integrated complexes, all within the last 2 years, two more large ones, Rongsheng Phase 2 and Shenghong's Lianyungang, with 200,000 barrels a day and 320,000 barrels per day capacities, respectively, are expected to be commissioned this year. Compared to conventional Chinese refineries that predominantly produce refined products, these new refining petchem complexes have been designed with 60 to 70% petrochemical use in mind, capitalizing on robust petchem margins while keeping the production of refined products at a minimum. Yet, the sheer size of these mega refineries will continue to swell the surplus of domestic refined products as the growth in supply outpaces any conceivable rise in demand. Exports from Zhoushan, mainly from Rongsheng's petchem complex, have risen steadily in the last 3 months to about 130,000 barrels a day in February. These additional cargoes will compete for market share within the region, keeping a lid on refinery margins and threatening the existence of older, less complex refineries. Next, let's talk about naphtha cracker capacities in particular. So naphtha imports into Asia this year will likely find support from the growth in petchem demand and with new naphtha cracker capacities coming online. In the first 2 months of this year, naphtha imports into Asia have inched above 6 million metric tons per month on average, surpassing 2019 levels by more than 15%. Close to 4.6 million metric tons per annum of new naphtha-based crackers are projected to be commissioned this year, which translates to an additional 15 million metric tons per annum of naphtha feedstock demand if all projected capacities come online, notwithstanding that a part of this demand will be met by local refinery demand, and hence the net incremental imports would be lower. In the same vein, arbitrage flows of naphtha from the US were disrupted significantly by the Texas storm that wreaked havoc on the PADD 3 refineries earlier this year. However, this shortage saw eventual rebalancing by ample supplies from Russia, Europe, and the Middle East. In recent weeks, we have seen a seasonal widening of LPG discounts to naphtha, which would favor cracker operators to switch to LPG if the spread widens to above $50 a ton, proving a potential downside for naphtha imports. Now, a little flavor about the freight market in the context of the naphtha supplies trends. Traditionally, the two tanker classes dominating the naphtha Middle East to Far East route have been the Panamax or LR1 and Aframax or LR2 classes of tankers. The lowered naphtha demand in recent times instigated the need for trading smaller parcel sizes, which in turn benefited the LR1 tanker class. However, a widening freight rate spread between LR1 and LR2 tankers has turned the tables in favor of the LR2 tankers, as it is currently deemed a more affordable solution. From the graph, we see that ton-mile demand for LR2 tankers is gradually increasing at the expense of the LR1s. Going forward, cheaper LR2 freight rates will continue to support the LR2 utilization rate. This will hold true until the freight spread between the two tanker classes narrows, making the case for LR1 tanker utilization economically viable once again. Next, we'll be discussing a little bit more about the trends in relation to the freight. Crude ton miles for all tanker classes to Asia is up 5% on average across the period of January and February, benchmarked against that across the last quarter of 2020. This is supported by stronger arrivals of Middle Eastern crudes into the region. Yet, we do observe signs of slowing in February against January, a result of slowing crude purchases, particularly by North Asian refiners ahead of the refinery maintenance season, which is expected to continue through April. Looking at vessel classes specifically, the lower VLCC and Suezmax utilizations during this period will continue to weigh on the already low freight rate, but momentum is expected to pick up in the second half of the year. Now, I'll hand the time back to Serena, who will be speaking about some key trends to look out for the rest of the year.
Thanks, RJ. So moving on to the last slide, question is, what are the key trends that the market will be looking out for this year? First of all, Asia's growing crude import appetite. Now, where will the incremental barrels be coming from? And will the rise in oil prices stimulate a rebound of OPEC and non-OPEC crude production? They will compete for market share in Asia. Second, for China and India's growing crude product exports. Now, can Asia's demand recovery keep pace with exports growth? And will arbitrage reopen to support more exports to other regions? And third, with the new refineries crowding out the older, less competitive ones in the region, could we see more refinery closures ahead? And finally, in terms of the freight outlook, will freight rates find support from the shift in Asia's crude and refined products trade flows this year? So with that, we've come to the end of the presentation. Just some housekeeping in the sense that, at the end of this session, we'll be sharing with you a survey. We hope that you could share with us your experiences about this webinar. So on this note, we'll start with the Q&A session. So if you have any questions, feel free to pop it into the Q&A box on your screen. So we have the first question coming in. Really interesting question. Now, do you think oil prices will remain in the $60 to $70 per barrel range this year? Well, I think, first of all, if you look at the factors that have contributed to the run-up of oil prices this year, there is an expectation of global oil demand recovery with the ongoing mass vaccinations, the falling infections that is expected to support more consumer spending as well as a rise in global economic activities. So that's on the demand side of things. Now, on the supply side, the OPEC Plus actually surprised the market with their commitments to roll over production cuts to April in their last meeting with Saudi Arabia, committing to the additional 1 million barrels per day of crude production cuts. And this is happening despite the strong rebound in oil prices at the start of the year. But the OPEC Plus views this as a really strategic decision that is really key to facilitate the ongoing market rebalancing to maintain a stable oil price. Well, as for the non-OPEC supply, prior to this, in fact, last month, the US Texas storm dealt a massive disruption on crude and petroleum supplies that further tightened the crude supplies in the market. And although much of the crude production has returned, we expect US crude production to be relatively moderated this year. And that is because, the general sentiments, especially with the major US shale producers this year, is very much focused on capital discipline. And they're really looking for, forward to, keeping their spending in control, believing that investors are likely to reward companies that show capital discipline over production growth. So if we look at the supply side of things, both the OPEC Plus and as well as non-OPEC are really committed to keep their production under control while allowing the oil demand to recover. So in that sense, if the market continues on a healthy rebalancing and production is moderated, we could expect oil prices to remain relatively elevated this year. Yeah, so I have a second question. Now, how do you think Asia's refining margins will perform this year? Well, another interesting question. First of all, if you look at Asia's refining margins this year, they have performed slightly better this year as compared to last year because of the improving prospects of the product cracks. But I would say that the refining margin still remains challenging for many refiners. And if we look across the barrel, I would say that gasoline has been the best performer in terms of growth because refiners have turned down their gasoline production and demand has been on a recovery, and that has kind of tightened the market by quite a fair bit. Well, as for diesel, recovery has been robust, and in fact, I would say that diesel recovery is kind of stronger as compared to gasoline. But on the supply side, diesel supply from the refineries has far outpaced demand growth, which has led to a surplus in the market and kind of taken a toll in terms of the diesel cracks, as we see in recent weeks. And overall, I think the refining margins has not recovered as strongly as refiners would like to, being dragged down by the run-up crude prices at the start of this year. And the rise in crude prices has and will in a way pass on to higher retail gasoline and diesel prices that in return will have a dampening impact on demand recovery and finally into the refining margins. So as such, this year will continue to be quite a challenging year for the refiners, but it will definitely be better as compared to last year. So another question that we have, finally, will Asia see more biofuel refineries in the next few years, right? Well, I think the future and the viability of biofuel refineries will be very much driven by government policies and mandates, because the cost of biofuels production is still more expensive than conventional fuels production. So in that sense, US and Europe will lead the way, because in these two countries and regions, oil demand is peaking and governments are accelerating efforts to curb carbon emissions. And many of these older refineries in the West are facing growing competition from new refineries in Asia and the Middle East that is eroding their margins and making it increasingly challenging for them to maintain their operations. So instead of shutting down, which will incur hefty costs for equipment dismantling and land restoration, the conversion to biofuels refineries will be an attractive alternative for many of the refinery owners. So with that being said, I think for Asia itself, the region will actually play an increasingly important role as a source of biofuel feedstocks for the West. Feedstocks including palm oil, rapeseed oil, used cooking oil, etc. And in fact, we are starting to see kind of nascent trials being done for some of the refineries to start trialing the production of biofuels. So for example, in the last week, we saw that Pertamina has announced that it is actually trialing the production of biodiesel production at its Cilacap refinery, and it's also building units at its Pelaju refinery to produce biofuel. So with that, I think that overall, there will be, and we can potentially expect an acceleration of biofuel refineries in the US and Europe, with Asia trailing behind. But Asia will play a key and essential role in offering feedstocks to the West for these biofuel refineries. I think with that, this is all that we have in terms of the time for questions and answers. If we haven't managed to answer your questions, we'll try to get back to you over the next few days with the answer to your question. Thank you so much for participating in our webinar. We hope to see you in the next webinar. So if you have 1 minute to help us complete the survey, let us know how your experience for this webinar has been. Thank you very much, and we hope that you've enjoyed the session today.